Welcome to the AAA Storage Podcast, your integrated real estate and development partner exploring all things self-storage investing to bring you diversified success. Let's dive in. Hello, and welcome back to another episode of the AAA Storage Podcast. And again, we have the wonderful, inimitable Paul Bennett. Thank you for joining. I am so excited to hear about this topic today because we are going to be talking about the capital stack as it relates to investing in real estate. So there are lots of different ways that you can get in on an investment deal. So there's debt, there's equity, there's different kinds of debt, there's different kinds of equity. And you mentioned before we started recording that, you know, there's ways to think about it from a risk perspective. There's ways to think about it from a type of capital perspective. There's ways to think about it in terms of who gets paid out first in the event of a waterfall or exit. So, Paul, I'll turn it over to you. Help us, me, investors listening. Tell us a little bit about the ways that you can invest, the different types of capital, and the ways that you guys think about financing some of these deals.
Yeah, absolutely, Brandon. And as always, it's good to have some time with you. As I thought about the capital stack in preparation for the call today, I chose to go at it in what might be an inverse order to try to give investors an idea of there are offerings at all levels of the capital stack in the market today. But to try to give investors an understanding of sort of risk and return and features, benefits. And so as they're reviewing multiple offerings, they can see and understand the difference in, for example, senior debt versus preferred equity versus mezzanine debt versus common equity, and what each offers an investor. And I can't help but also maybe put a little bit of insight in there from a sponsor perspective, because there are reasons why those different areas in the capital stack are attractive to sponsors or not attractive to sponsors. So yeah, we're going to attack it from an inverse order, really starting with the part of the capital stack that has the least risk, which is senior debt. Senior debt is debt that is secured by a deed of trust and secured by the property itself. It typically carries the lowest return in the capital stack, but also represents the lowest risk, because as a lender that has a lien or deed of trust on the property, if something were to go wrong in the deal, you have the right to take possession of the property in order to repay the debt, the loan that you've made. And typically, for example, in self-storage, we're required to put at least somewhere around 30% of the cost of a project into it as equity. So you've got a 30% buffer if you're the senior lender. That project has to be, worth 70% of its projected value, its cost to construct, before the senior lender's exposed at all. But they're protected by, like I said, a deed of trust and a lien, a promissory note on the property. And there are tons of senior debt funds out there today that are offering investors the opportunity to invest with a sponsor who's then going to in turn loan that money to a developer or someone that's acquiring real estate. And the senior debt typically carries current cash flow. In other words, you're going to get a quarterly or a monthly dividend that's reflective of the interest rates that the debt fund is charging. And in some cases, they're going to provide some liquidity. You're going to be able to resell your interest or your shares in that debt fund to the sponsor and get your cash back. Not all funds offer that, but a lot do. But it's a lower return in today's environment, probably somewhere in the 6-7% range in terms of return, but lower risk, and in some cases does offer some liquidity, which is not common in real estate. Real estate is generally an illiquid asset, and you really don't get true liquidity until you sell the property.
Very helpful. Okay. I just want to preface a lot of what you're saying. I have an MBA and I went through a bunch of finance classes, and it was all very confusing to me. And there's so many details, but what you're providing gives a very, very good summary, and also like interest, like why does it matter what kind of investment vehicle you choose, I think is really, really helpful.
The easy analogy, Brandon, is everybody listening to this podcast probably has a mortgage on their property.
Yep, right.
And the lender that loaned them the money to buy that house is the senior debt in their transaction. Yep. And as we all know, if you don't pay the mortgage payment, ultimately they'll come knocking and they'll take your house from you, and in their case, they'll resell it and hopefully get the amount that they loaned you back. And essentially in commercial real estate, it's really no different. Obviously, the risk is a little different and the terms are often quite different, but it's the same thing. It's the senior debt, it's the senior lender that has the first lien on the property, and is in the most protected position of anybody in the capital stack.
That's great. Okay, perfect. Okay, so what's next? If you're not doing senior debt, what's the next level up?
Remember, we're kind of going bottom up, if you will, but the next step in the capital stack is mezzanine debt, or often referred to as mezz debt. And it's basically, since I use the homeowner analogy, it's a second loan. It's like a HELOC. It's like a home equity loan, which is in a second position to the senior lender. So if the property were foreclosed on by the senior lender, and the proceeds from the sale only generated enough cash to pay back that senior loan, the mezzanine lender would be left holding the bag. So it's a little bit riskier. It's quite common in corporate finance. And in fact, in corporate finance, mezzanine debt often also includes an equity component like warrants to purchase shares or other equity-like mechanism that gives the mezz debt a little upside. That's not really common in the real estate world, and it really is additional leverage over and above what the senior lender is willing to do. And therefore, because it's a little riskier, provides a little bit higher return or interest rate than the mezzanine, than the senior lender. And it's often shorter term. Senior debt may be on a 20-year amortization or a 25-year amortization. In today's world in commercial real estate, longer amortizations but shorter terms are not uncommon, a 5 or 7 year term with a 25-year amortization. Mezzanine debt is usually shorter term in nature, probably 5 to 7 years or less in most cases. And it does carry, like I said, a little bit higher rate because it's a little higher risk for the lender. And it's not quite as common in small to medium-sized commercial transactions, more common in very large, I'm talking, $100 million and up real estate transactions. And it's not an area, there are not as many offerings for investors, particularly high net worth investors, in the mezzanine sort of tranche of the capital stack. But it is there and it is used in commercial real estate. And it just falls second in line in terms of risk. It's second in line for a sponsor in terms of cost. It's less expensive than preferred equity or common equity, but more expensive than senior debt. And so it is used, fairly commonly in commercial real estate. It's something that we typically don't do in any of our funds. Our funds are typically, our capital stack is very simple. It's common equity and senior debt, which is not uncommon in the real estate world. But the mezzanine piece is an interesting piece, a little bit of a hybrid that does provide a little bit of additional return. And there are mezzanine funds out there for investors who want to invest in that tranche of the capital stack.
That's really helpful, the mortgage to home equity line of credit kind of look in that, because I've always heard of it in a venture kind of context is the way that I've studied it, where it comes typically later stage in a raise round for a company. And it's a lot more creative, a lot more interesting. But you saying it's like the second stage, like a HELOC, that's really helpful.
Yeah, there's a loan in the first position, which is senior debt, has the least risk. And then in this case, if you're using mezzanine debt, it's a second loan, like a second mortgage, that in fact, it is a second mortgage, even in commercial real estate, it's subordinated to the senior debt. And in often cases, the senior lender will require certain conditions be met before the mezzanine lender can be paid. Sometimes it'll allow interest payments, but no principal payments unless certain conditions are met. But it is a second lien on the property that stands behind the senior debt. And there's some interesting opinions on mezzanine debt. If it is used in an attempt to over leverage a property, I think it carries a tremendous amount of risk.
Interesting.
Leverage is a two-edged sword, right? It increases returns on equity, but it also can overburden a property and make it very difficult for that property if something doesn't go just right to meet its debt service requirements. And when you do that, you expose the other part of the capital stack, which is the equity part of the capital stack. I'll tell you, I cut my teeth in the real estate industry, and particularly in real estate syndication, started in 1981. And from 1981 to 1986, there were a lot of tax-motivated transactions. They were really designed to create write-offs for investors more so than they were to provide really solid economic returns. Not all of them, there were a lot of them. And so in order to boost the tax benefits, there was a lot of leverage in a lot of those transactions. And mezzanine debt was probably even more common then because you had senior lenders that would only go so far, but a sponsor wanted to really lever the deal up and create a disproportionate amount of tax benefit relative to the equity in the deal. And in 1986, the government passed TEFRA, the Tax Reform Act, that changed a lot of the rules, and you saw a lot of those over-levered deals hit the wall and explode because they simply couldn't sustain the economics of the project with the cost of debt that they were carrying. So I think it can be a positive thing, and it can be a good place to invest. But I think it's a place to invest with some caution, because if you think you're making an investment that has very limited risk and it's mezzanine debt, that may or may not be the case, if that makes any sense.
I love your insights going back to the 80s, because you've been investing in real estate longer than some of our listeners, including yours truly, have been alive. So I think it's amazing. Okay, great. Thank you. Okay, so next step is, mezzanine, and then there's...
Yeah, so senior debt is the lowest risk and lowest cost in terms of sponsor cost or owner cost. Mezzanine debt's we talked about that. The next tranche in the capital stack is preferred equity. And preferred equity is an interesting animal because it is equity, but it sits in the capital stack from a waterfall standpoint. And by waterfall, I mean, if you sell a piece of real estate, the first guy to get paid is the senior lender. The second guy to get paid is the mezzanine lender. The third person to get paid, it generally is the preferred equity investor. So it stands in front of the common equity in terms of risk exposure and distributions upon a sale. The difference between preferred equity and common equity is that preferred equity typically carries a fixed coupon or return. It depends on how the deal is structured, but in some cases, some of that is paid actively. So in a preferred equity position, maybe the total coupon is 12%, and 6% of that is paid actively, and the other 6% is accrued and paid when the property's sold. But in all, you're going to get a 12% annual return on your investment. But it's a fixed. It feels in some ways like debt because it has a fixed coupon attached to it, but it functions like equity because you're standing behind the senior lender and the mezzanine lender. You do not have a lien on the property, and if the waterfall upon a sale doesn't get to you, in theory you can lose all your money, and that's really not realistically not the case with a senior lender. May be the case to some degree for a mezzanine lender, but the preferred equity investor is generally more exposed than either of the debt tranches in the capital stack. But they're going to get paid before the common equity does. And like I said, usually carries a fixed return. We've even considered adding a pref equity class in our fund structure. We may look at it for a future fund. From a sponsor standpoint, senior debt's the least expensive. Mezzanine debt's a little bit more expensive. Pref equity, a little bit more expensive yet. But all three are significantly less expensive than common equity, particularly in a project that does well. Because the difference between preferred equity and common equity is that there generally is no fixed return. for common equity. And you're totally exposed in terms of the possibility of losing all of your investment if the other tranches in the capital stack can't get repaid through the sale of the property. However, in a property that goes well, your upside isn't capped. You're going to get whatever proportion of that common equity distribution that you're entitled to based on the sharing arrangement and the waterfall within the fund or entity that you invest in, but there is no cap on that. And so ultimately in a project that performs very well from a sponsor's standpoint, that's the most expensive capital of all. And as I said, in our current fund and right now as planned in our future funds, we really only have 2 of the 4 tranches of the capital stack in our capital stack, and that's common equity and senior debt with no mezz debt or preferred equity in between those 2. I hope I've done a decent job of sort of explaining the differences in them. I feel like sometimes I'm maybe not quite getting all the way there, but there are, as I said, each of them offer an investment opportunity. They have different risk and return profiles, and depending on the vehicle in which you invest in them, they can have different degrees of liquidity. Common equity in real estate is typically not liquid at all. You're going to get your original capital back in whatever return you're entitled to when the property's sold. You may get some cash flow distributions along the way, but in terms of redeeming your interest or getting your original principal back, that's really going to require sale of the property. Some of the debt funds do allow for redemption and therefore the ability to get your principal or part of your principal back along the way, but the common equity generally doesn't. So.
Interesting. Okay. So just to be clear, on the preferred equity side, you do get some of that cash flow along the way, like you're saying, at a fixed rate, but then your upside on a property that goes really well is unlimited like equity. So you get a little bit of a mix of the debt, I guess the outcomes or distributions or cash flows of the debt plus equity. Is that kind of how I'm understanding
on the
it?
Preferred equity side, your return's usually fixed.
Fixed. Okay.
It is not, you don't have unlimited upside or really any upside. A preferred debt, a preferred equity offering, would look like this. The preferred equity class would be entitled to receive a total return of 12%.
I see.
That return can be paid part of it currently and part of it upon sale of the property. But regardless of when it's paid, you're never going to get more than a 12% annual return.
Got you. Okay.
The common equity is the slice of the capital stack that has unlimited upside in terms of what the ultimate value of the property is.
Gotcha.
Pref equity, for example, in our transactions, which we are development oriented, which means there really is no operating cash flow for a period of time. In a development environment, the pref equity is not probably going to get any current return at all. All of their return is going to come at the end of the project when the project's sold, because there is no cash flow. You'd essentially be giving people back their own money, right? If you were paying any return at all, because you're just paying them back their own money. That doesn't make any sense. I'll give you an example. About 6 years ago, I developed an $80 million mixed-use project just outside Charlotte, North Carolina. And we had a substantial amount of our equity in it, but we also needed some additional equity. And we worked with a group out of Charlotte, happened to be Centerlane Capital, great bunch of guys. And they put together an offering, went to their investors, and it was all preferred debt. So they basically invested $7 million in the project. Because it was a development project, there was no current return on that $7 million. But when the property was sold, they got back their $7 million plus 14% per annum for the entire period their money had been invested. And once they received that, they've now been paid out, and the next funds that were distributed from that sale were paid to the common equity. I don't know if that helps clarify.
Yeah. Yeah, no, that's super helpful. Okay. This is some of those things that, I was a solid B student and it just got a little confusing to me. We were moving quickly through class. So the way you're explaining it is actually really, really helpful.
Well, sometimes it can be the student and sometimes it can be the teacher. Maybe I'm not doing a great job explaining it. I had it really clear in my head when we started all this. And, but yeah, I mean, everybody's familiar with common equity. Everybody's familiar with senior debt. The two pieces that they may not be as familiar with are the preferred equity and the mezzanine debt, which are sort of hybrids. Mezzanine debt is a second loan. So again, different risk profile, different interest rate because of the risk. Preferred equity is equity, but it doesn't have a lien on the property, and it usually has a fixed return versus the common equity that is the riskiest position, but also has the most upside. Hey, look, here's the reality in investing in anything. Risk and return are inextricably linked. The higher the risk, the higher return you should expect. The lower the risk, the lower the return you should expect. And risk here is defined by the ability to first get your original capital back, and secondly, to get the return that you started out and invested for in the beginning. And senior debt, high probability of getting your principal back, high probability of getting the return you were promised. Mezzanine debt, slightly less probability or slightly lower probability of getting your principal back and of getting getting the return that you were looking for, but certainly a significant expectation that both of those things will happen. Preferred equity is a pretty protected position as well. You're going to, the common equity that invested in the deal can't get a dime of their original principal or return until the preferred equity has gotten all of its principal back and whatever return they agreed to. So again, we kind of went that bottom up, senior debt to common equity, but that's how they all relate to each other, and therefore how investors should think about them. At the end of the day, it's about risk-adjusted returns, and is the balance between the risk and the return appropriate and not distorted?
If you don't mind, I want to keep going with that train of thought you just started, because a question that comes up hearing you listen to explain all this is how should I, if I were an investor, how should I be thinking about what kind of class or what kind of capital I would be thinking about investing in a project? Let's say there's a fund, a real estate fund that's got all four types. Maybe some wisdom or just some kind of decision criteria that helps me understand where do I want to fit in that capital stack. I don't know if you have any that come to mind, but that's kind of where I go with that. And then I also, if you don't mind, just a few more minutes too, is why you guys chose just the senior debt and the common equity. And if you've looked, you mentioned looking at some of the mezz debt or preferred equity, but why you ultimately stuck with those two. Maybe just a few comments on both of those questions.
I think the first question you ask is why would somebody gravitate to one tranche in the capital stack versus another? It's first and foremost driven by their investment objectives. If you're an investor who's investing for current income and you're at a stage or place in life where exposing your principal to any significant risk is not advisable, then you're a senior debt investor, because that is the tranche in the capital stack that best matches your investment objectives. That would apply to somebody who's approaching or in retirement, where they don't have a lot of time to recover from an investment that goes sideways. And at that stage of life, they're typically looking for current income, right? Because they may be retired and they're living off the investment income they can generate. And so it's really driven by your investment criteria. The other thought you triggered when you asked the question is, if you're going to invest in any one of those tranches, but we'll use senior debt for now, what skill set is critical for the sponsor that you're investing in? And the answer to that, particularly for senior and mezzanine debt, is their ability to underwrite risk. So think about the process that you went through when you bought a house. They wanted your bank records, they wanted your credit card statements, that's called underwriting. They wanted your credit score. They were evaluating your ability to repay that loan. Commercial underwriting is no different. They're looking at the viability of the project. They're looking at the projections for the project. They're looking at market data. As a lender, they're looking at the sponsor and his experience and his track record. And so if you're investing in a debt fund, whether it's mezzanine or senior or some combination of the two, they're basically acting like a bank and making loans. And so you want them to have a wide and deep expertise in the underwriting of those loans and identifying the risk, because you might underwrite the right project but offer too much debt. Like the project may be okay, but if it's over levered, so not only the ability to evaluate the project, but also to evaluate how much debt should that project really get. So anyway, I probably went too far there.
No, that's helpful.
But that's the other piece of it. But it really is, again, they slide. I went inverse. The first thing we talked about, senior debt, has the least risk. Common equity has the most risk. I would tell you in the corporate finance world, there is a real possibility that whatever stock you buy could ultimately be worthless, right? I mean, that's a real possibility. A little less true in real estate because it's a tangible asset, tends to never go to zero. But if there's leverage involved and the leverage is obviously in front of you, it's not impossible in a real estate transaction to wind up with a common equity getting nothing back. It doesn't happen very often, but it's not impossible.
Yeah, interesting.
And so you've got different levels of risk and therefore different levels of return. So the investment objectives really are what makes sense. In your peak years, you're probably more growth oriented. Common equity offers, the best growth opportunity. Those are the investors that we have in our fund. They're people that are looking to grow their equity base. They're not as concerned about current income. And the way we leverage our projects, and because we're in an arena in self-storage and office industrial flex that has pretty consistent consumer demand, the common, when I say it has the highest risk, that doesn't mean it's overly risky, if that makes any sense. I mean, I can tell you this, we've done over 100, we've made over 100 investments, 90 of which have gone full cycle. There's not one instance in which we haven't at least given our investors every dollar they gave us back. We've had a couple of projects that were in the single-digit return, so original principal plus a 2, 3, 4, 5, 6 return. Fortunately for us, they're very rare, but we've never not been able to, give our investors their principal back. So.
That's an amazing statistic or factoid from your work. I mean, you've been doing this for decades, and that is the case after doing this through, like you said, full cycle deals, up market, down market, all of that. That's amazing that you are that successful in that way. And obviously you can't, past performance does not indicate future results, but that you have that kind of track record is truly incredible.
Well, thank you. I think we're very proud of it. Part of it is, we're pretty good at what we do. The other part of it is we're in a segment, even though we're in development, which is the riskiest part. I guess if you kind of think about the real estate industry in segments, the riskiest play of all is raw land, right? That's the riskiest play. The next is the vertical development. If you're buying existing properties with established cash flows, that's the least risky play in the real estate world. But within that development world, that vertical development world, which is where we sit, we're developing a product that has historically been more predictable than the other segments in real estate. Self-storage and office industrial flex has had just such consistent demand over time that it's a little harder to screw it up than it is developing an office building or shopping center or, other types, multifamily, where demand and, ebbs and flows dramatically in some markets. So anyway.
Yeah, truly amazing. Well, Paul, thank you so much. I feel like I say this every episode, but I love listening to your insight and your expertise. And also to listeners, this is very valuable information that I paid a lot of money for in business school to understand. So Paul, you're the way that you're able to explain it helps me understand so much. So I hope that listeners are taking notes and re-listening to this and thinking through it, because it is actually super, super helpful.
It's always fun, Brandon. I love I love what we do, and I love, talking about it, and I love trying to help people understand it. I feel like today I might have fallen a little bit short. I didn't feel like I got as clear for you as I'd like to, but I hope it's beneficial and hope people enjoy it. So.
No, this is great. Thank you so much, Paul. Next episode, next week, we may have a special guest on. So I hope that listeners will stay tuned for that, and we will see you then. Paul, thank you again so much.
Pretty excited, Brandon. Take care.
All right. See you.